All right, everybody, let's get our webinar started. Appreciate everybody's time today. Thank you for joining us. We're going to be talking about replacement property and alternatives in the 1031 exchange. My name is Rob Curtis. I'm the Business Development Director for Accruit. My guest today is Paul Hogenson, founder of DST Investment Advisors. Paul, would you like to introduce yourself and say something about your company?
Sure. My name is Paul Hogenson. I'm the founder of DST Investment Advisors. I've been doing this right around 4 years. I founded the company because I knew that there was going to be a need into the future. I operate out of Scottsdale, Arizona, and we're a small firm. We're going to dive into what we do here in a little bit so we can kind of take it from there.
Perfect. Thanks, Paul. A little bit about Accruit before we get started. Accruit is a leading full-service qualified intermediary, or QI, and developer of the industry's only 1031 exchange workflow technology. On a security standpoint, we carry $50 million fidelity bond, $25 million E&O, which is errors and omissions policy, $20 million cybersecurity policy. On the experience standpoint, we manage up to $9 billion annually in exchange transactions as a QI. And for our experience, Accruit has gained the trust of thousands of clients and become a leader in the industry through its highly credentialed experts, consistent delivery of service, innovative technologies, robust security protocols, and financial strength. Accruit also specializes in the complex tax deferral strategy to help preserve wealth, build investments, and secure financial well-being. Through our modern technology systems, comprehensive set of solutions, and highly credentialed subject matter experts, we can feel confident that the job will be done to the highest standards. My disclaimer, I am not a CPA, I'm not a tax advisor. When it comes to a 1031 exchange, we highly advise you to lean on your tax experts. They're the ones you're going to use they know your tax position, your liability. We stay in our 1031 lane, so we don't get into the tax advice, even though we're dealing with tax strategies.
And Rob, I have a similar disclaimer. I am not a CPA, and I'm not an attorney either. I do give financial advice, and I hold a Series 7 and 65 and 63.
Perfect. Thanks for sharing that, Paul. When we're looking at Section 1031, 1031 exchange, what is it? It's a tax code, IRC Section 1031. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held for productive use in a trade or business or for investment. That's one big sentence, Paul, but it's the backbone of the 1031 exchange, basically saying both properties, what you're selling and purchasing, need to be held for productive use, business, or trade, excluding things like personal property, your primary residence, stocks and bonds, partnership interest, right? Real property for real property.
Yeah, and that's right. And, we might want to spend a little more time on that and, make sure everybody's up to speed on kind of the basics of what we're talking about. IRS tax code 1031 allows you to sell a property held for investment, use a qualified intermediary like yourself. And one of the things we're here to talk about is what are we going to do on the replacement property side?
That's right. That's right.
So we're going to dig into the rules here on 1031 exchange because everybody needs to follow those to begin with, right? And we're going to get into how what I do helps facilitate a 1031 exchange.
Awesome. Thank you. Let's look at the process of a 1031 exchange from just simplistic terms, looking at it down from 30,000 feet, what it looks like. First and foremost, you want to get your investment property listed on the market, get it under contract, vet out your QI, talk to them about what qualifies, walk through that process. But you want to get the exchange file open prior to the day of closing, keeping you from a taxable event, right? That's where our primary focus is. We're working with our clients.
That's right.
So our job as a QI is to primarily to facilitate the 1031 exchange and hold the funds, keeping our clients out of a taxable event. So we want to do that, set this exchange up prior to the close of escrow. So if today was a close of escrow, you would have 45 days to identify what that property or properties you want to purchase as replacement property. And then beyond that, you have another 135 days, 180 consecutive days to complete the exchange, meaning close out, purchase what you've identified. Now, at the close of escrow, those sales proceeds come to us, the QI. We hold those in a segregated account, never commingled with our funds. And those are tied to an EIN or social security number. And we share that data with our clients. They know how much is in the exchange fund. They know what period, the day they're in the D period. They know what day they're in the exchange period as well. So once they have identified that a replacement property, we then transfer the funds over to the closing agent so they can purchase and finalize the 1031 process within the exchange period of 180 days. Anything?
That's right. And I think we should spend a little more time on this as well. 45 days seems like a fair amount of time, right? Until you're in that situation. And then it doesn't seem like enough time at all, right? Let's talk about kind of a couple of the different ways that people identify property, right? So that also ties into what I do. So the original main way that people identify property is the 3 property rule, right? We also use the 200% rule. So we'll talk a little bit more about that, but it does come into play in terms of how people are completing their exchange, right?
And I can add some value to that. 3 property rule is really simple. You can identify 1, 2, or 3 properties regardless of market value. So say you're selling for $1 million, each one of those replacement properties could be $3.5 million each, regardless of market value.
That's right.
And why do folks use that the most is because the 3 property rule really comes into play as backup. Say you really want 1 property, we'll identify 3 and the other 2 serve as backups. What happens if something happens to that number 1 property during the inspection period? It has a bad roof, foundation, a million things could go wrong. You walk away from it and you have nothing else. The exchange will collapse. So the other 2 are really kind of a backup plan for you.
That's right. And I wanted to talk about that specifically because clients will have 1 property in mind, and absolutely it's easy to identify that 1 property. But what we do is provide replacement property as backup, like as an insurance policy, and we'll dig into that more as well. Now, you were going to talk about the 200% rule?
Right. 200% rule is easy as well. So if someone says, hey, Rob, we want to purchase more than 3 properties, we're going to move them over to the 200% rule. And that one's pretty easy too. Simply states you can purchase as many properties you want as long as you don't exceed 200% of the fair market value of what you sold. So one caps you how much money you can spend. The other one caps you how many properties you can purchase.
Excellent. Yep. And when people are in the middle of this, it really does become important.
So when we're looking at alternative investments for replacement property, Paul, this is why I brought you in today. So a lot of times when we're talking to our clients, we know what they're selling. We know what the debt is. We know how the entity holds title to that property. When we ask them what the replacement property is, sometimes they know and sometimes they don't know. And when they don't know, the question comes up, well, why is that? Are they aging out of real estate? Do they not want to own real estate anymore? And if that's the case, we have to open up alternative investments that are allowed through the 1031 exchange. And that's where professionals like yourself come into play.
That's right. So I'm going to dig right into it. Okay. What we're talking about here today are replacement property for a 1031 exchange. There's a few different ways to do this, right? You can certainly, buy and manage your own real estate, right? You can go into a structure called the DST, which we're going to get into very, on a deep level. And then prior to DSTs, the investment of choice was a TIC, right? Or a tenants in common. And so really what we found is that the DST is primarily replaced the TIC structure because of deficiencies in that structure. Okay. And we can dive into that on a deeper level as well. But what is a Delaware statutory trust or a DST? Okay. I like to explain it that it's replacement property for people that are doing a 1031 exchange. It's bigger than that, but it is almost always commercial real estate that generates cash flow that a large group called a sponsor group, who is normally a large real estate company, goes out and acquires usually a large asset somewhere north of $20 million, right? All the way up to, I think the top one in the marketplace is over 600 million now, right? One asset or one DST. And then from there, they put it into this structure the Delaware Statutory Trust. And once it is, then they can offer percentages or the equity in that real estate to investors, several investors. Okay. So that's really what a DST is. It's a piece of commercial real estate that generates cash flow normally, that allows investors from a 1031 exchange to invest into a portion of that asset that then becomes managed by the sponsor group. And from the investor perspective, what happens is they receive a monthly distribution.
Got it.
Okay. Am I missing anything there? We'll get into the rest of this on a future slide. So when is a DST useful? We have a saying in this industry, are you tired of tenants' toilets and trash? Okay. If you've managed rental real estate for any length of time, the answer is going to be yes at some point. Okay. Is it 30 years? Is it 40 years? Is it 5 to 10? Right? Everybody has a different answer. Okay. But a typical client will come to us through a QI like yourself, and they're just all done managing real estate. They've done it their entire careers. Oftentimes it's a fully depreciated asset, so the basis is zero or close to zero, meaning that they don't get the tax benefits that they should get from owning real estate, right? Most of the time the asset's paid off and they are looking to sell that asset. They would absolutely want to defer their taxation, right? We'll get into another popular saying in the industry. But they want to defer their tax, and then they want passive ownership of real estate to continue to generate cash flow. Okay, so that's a very typical client for us. But within the 1031 space, we see everything, right? So it could be, hey, I sold an asset for $1 million and I found another one for 600,000 or 800,000. What am I going to do with this 200,000 to 400,000? I don't want to pay tax on that either. Okay, so we get into lots of situational work where we're able to invest the remainder, the equity boot. We do debt replacement on a regular basis. So if you sell an asset for $1 million and you have a $500,000 note, you can still do an exchange, right? In 1031 exchange, if you don't replace that, what do you call it?
Cash boot?
Mortgage boot.
Well, mortgage boot, I'm sorry.
Right. So we have our DSTs, several of them have financing already in place. And so we're able to cover mortgage boot for folks on a regular basis.
That was one of my questions for you later in the presentation, but that's great you addressed it right now.
All right. Well, we're going to keep going here. Let's talk about some of the advantages of DSTs. Okay. And when I get into this, I like to talk about actual stories. Okay. So right now, today, most of our clients are selling assets that are fully depreciated, that have no loans. And so they don't get any of the benefits that they should get from owning real estate. Okay. So if that same client sells for $1 million and invests in a DST that already has 50% leverage in place, okay, they are essentially buying $2 million worth of real estate. Okay. They take their investment, they're going into something with 50% loan to value. Okay. So now from a tax perspective, they are able to depreciate a new $1 million. Okay. They start a new depreciation schedule. Because there's interest on this loan, they get the advantage of interest expense. One of the things that happened in the most recent tax bill, the one big beautiful bill, is that cost segregation was made 100% year of. So if you're investing in an asset like this, the sponsor goes out and does a cost segregation study. Now, we're getting a little complicated and into the weeds here, but that's what we're here for. So let's keep digging.
Okay.
Okay. cost segregations are able to pull potentially a third of your depreciation up front into year one. Okay. It's a huge tax incentive that people didn't have before they came and saw us.
Are most of your clients aware of this now?
We have the conversation. It gets technical pretty fast. We like to bring in CPAs to verify everything. Hey, when people understand that they can have 100% of their distributions be, tax-free because of things like cost segregation studies and bonus depreciation, they want to hear about it. Okay. In terms of questions, I know we're getting into a lot of information here, so I want to leave it to the end on this. But this is really important stuff that people should understand.
Perfect. Thanks for sharing that information. I know we're going to unpack a lot of information today, so a lot of this is coming up, but we'll hold up questions for the end.
I apologize for getting so deep so early.
It's okay. It's what we're here to do. So when we look at alternative investments as a replacement property, at any given time, there seems to be, to me, hundreds of options out there, and I don't make any recommendations. I'm not licensed like yourself, so my conversation stops at some point where I make a warm handoff to an investment advisor to take that client down the road of what these options look like. So can you walk us through how you vet these DST options to present to your clients and what that looks like?
For sure. So at any given time, the DST marketplace is, 40 to 60 different offerings. Okay. Maybe as many as 40 to 50 different sponsor groups. And let's think about it as any given time we have $2 to $2.5 billion worth of equity that we have available to place. Okay. So that's a lot to take in. And for a general investor that doesn't do this for a living, in a lot of cases, they rely on professionals that do. Okay. I do this every day. I have been to most of the sponsors' headquarters. I've met with executive teams. That's stuff that, somebody that doesn't do this every day for a living just doesn't have the time for. So once you're comfortable with the sponsor group, and let's say that we're comfortable with, 10 to 12 different sponsor groups at any given time, that provide inventory on a regular basis, that have long track records of success, full cycle events, that are good stewards of investors' money, right? Ultimately, they're taking in lots of investor money. How good are they at managing that money, right? Are they looking out for their best interest ahead of investors, right? These are things that everybody needs to know, but unless you're looking to read multiple PPMs, do web calls with executive groups and everything else, how are you supposed to know this information? Right. So people really do rely on us and trust us to do our work and our vetting. Hey, that's not even to mention that we have to vet, several asset classes, right? So we do a lot of work in the multifamily space. We do a lot of work in industrial currently. Net lease. Everybody, is a big fan of net lease till they're not. We have to understand, all the different asset types and how they operate and things like cap rates and distribution rates and risk profiles.
Yeah. There's a lot going on in your world.
There's a lot to vet out. And if we want to get into, how we do that due diligence, I think that's important for people to know as well.
Well, for our audience right now, can you explain to them the hierarchy or the org structure of what a sponsor is, what a broker-dealer is, and how the IRAs fit in within that structure?
Yeah, so it's a capital raising environment. So the sponsor groups are large real estate groups that go out and, hold on, bear with me. Sponsor groups are large real estate groups that go out and acquire a large real estate asset. Okay, let's think $100 million. Okay. We don't know who the tenant is, but let's say that there's some investment grade tenant, right? Somebody maybe listed on the stock exchange. Okay. They are going to get all of their leases in place. They're going to know the financials of the building. They're going to know, the operations. They're going to put all of that into a pro forma, put it all into a PPM, and offer it in this structure called the Delaware Statutory Trust. From there, they go out and need to raise capital. So they're going to sign selling agreements with groups within the broker-dealer network and the RIA network. Okay, so there's a couple of different ways these groups are raising capital. Okay, from there, once my broker-dealer goes ahead and approves an offering that was coming from one of the sponsors, then we're able to offer it for investment, right? And after we've done our diligence on it, it may be something that we offer to clients.
Okay, great. Thanks for sharing that with us, Paul.
Yep.
Moving along in regards to DSTs, liquidity and exit strategies, what is a typical hold period of a DST that you see?
Yeah, so in general, right, I mean, we're talking about buying a real estate asset. Okay, let's think about a brand new construction multifamily. Okay, if you're going to go out and acquire a brand new construction multifamily, it's going to take you 5 to 7 years to make that a profitable asset to your investors. Okay, first off, we need to follow the 1031 exchange rules. Okay, so in general, the sponsor groups believe that they need to hold an asset for at least 2 years. Okay. After that, there's a front end load on DSTs. That's how I get paid. That's how everybody in the process gets paid. Okay. So that front end load takes a while to have the asset go up in value to cover that. Okay. All the way along, the sponsor group is trying to raise rents. They're trying to minimize expenses. They're trying to find additional ways to raise cash flow. And over a 5 to 7 year period of time, assuming that they're going to be able to sell at the same cap rate that they bought it for, that's how they make money for investors. Okay. Again, this is commercial real estate. So what we're talking about is net operating income and cap rates. Right? That's how they determine what they're buying it for. That's how they determine what they're selling it for.
Perfect. When we're looking at exit strategies, what does that look like for a DST?
Yeah, so
can an investor pull out early, or what does that look like for 1, 3, 5, 7 year, 10-year terms?
Yeah, so investors should think that they're getting into an illiquid asset because they are. That's what real estate is. If you're going to be buying commercial real estate, unless it's going to be some sort of value add proposition like a flip, which none of these are, they're almost always brand new assets. They're going to manage the asset for 5 to 7 years, let's say, and then at some point, this asset's being marketed for sale. And at that point, they're going to accept an offer that returns, the right hurdle to investors. Okay, so what happens? You're going to get a call or an email from the sponsor group, or notification of some sort, saying that they've accepted an offer. Okay. In a traditional DST where you're selling this to a non-affiliated third party. Okay. So what are your options at that point? Well, you have 100% of your options available to you again, right? So you can decide to pay the tax if you choose, right? You can open another exchange. And so you should get a hold of Rob or one of his counterparts over at Accruit, right? You open another exchange. You The asset sells, the money goes into the exchange, and now you have 100% of your options available to you again.
To go buy real property or another DST or whatever suits
That's
your...
right. So if you want to manage property again, if you want to go into another DST, if you want to go into, a TIC or some other structure that works for you, right? But in general, the sponsors want to do such a great job and have another asset right there available to you again. So if you liked how that sponsor group operates and they provided a good return, they're going to have another asset there waiting for you. So you'll open another exchange and they'll be sure to let you know that they have another one ready.
So more options at the end of the DST.
That's right.
Good.
Right.
Thanks, Paul. Let's move over to risk management. When we look at the risk in today's DST markets, what do you see?
Well, and again, you should think about this in terms of investing in a piece of commercial real estate. Okay. And each asset type has its own risk profile. Okay. A triple net lease with one tenant is very different than a multifamily with 400. Okay. So you have all the risks of owning real estate. Let's start with that. Okay. Several of these options have all equity, no financing at all. Okay. So if you're coming out of an asset with no leverage, it's paid off, and that's what you want. We have several offerings like that. The reason why I bring that up is because that takes care of foreclosure risk.
Got it.
Right? Duration risk is something that people, consider all the time. Do I want my money locked up for 5 to 7 years? Okay. We do a lot of estate planning work with DSTs, and we'll get into that later, right? And so we'll talk about how we diversify risk, how we create portfolios to create the best risk-adjusted return, right? So we have a lot of flexibility to mitigate risk, but everybody should know that they get real estate risk and everything, just like if they were going to sell this asset and go buy this asset over here. You have all of these risks just the same as if you're buying your own, except you have no capital calls. Nobody's ever going to ask you for more money, right? You don't have any credit risk, right? So if there are loans, they're all non-recourse loans, and they don't affect your credit or anything related to that. There's a number of risks that come off the table by going into passive ownership.
Got it. Perfect. Thank you for sharing that with us. And then final question on the risk management side. With higher interest rates that we're seeing today, how does that impact the DST world?
Yeah, again, it's all commercial real estate. So anything needs to be able to pencil, right? If they are going to get financing on these properties, they still need to provide cash flow to investors. So in some ways, it slowed down the amount of supply. It also slowed down the amount of people that are able to sell their assets, right? We get calls from people all the time doing our upfront educational work, and they are just putting their property on the market. Okay. Well, higher interest rates affect their ability to sell too.
Right.
Right. So not that it's been terribly slow. There's a lot of pent up demand to sell real estate assets that have been held for a long time. So we are seeing a lot of transaction volume. But at the same time, you need to reinvest in something that's going to provide a good return, and interest rates really do affect that.
Awesome. Thank you. Now, talking about 1031 exchange considerations, where our worlds kind of come in together, let's talk about that a little bit. In your world, how do you see DSTs helping investors meet their 1031 exchange requirements?
Yeah, so in a 45-day period of time, if you sell and then have to go drive around and find a property and do your MLS work or CoStar work and find a suitable replacement property, just even one, doing that in a 45-day period of time can be difficult, right? Stressful, right? There's a lot of things, moving parts, right? It's difficult, right? And the clock's ticking. In our world, we solve that problem easily, right? At any given time, we have $2.5 billion in equity right there available. right? I will almost guarantee you that we have 10 offerings that we can put in front of you to create a portfolio within a 45-day period of time, with you being able to do your due diligence and feel very comfortable in your decisions without having to stress or get in a car or work with agents, okay? Not only that, you're not reinvesting money. You're not doing inspections. You're not doing appraisals. You're not going to the bank and doing lender-related things, okay? Everything's prepackaged, ready to go. So in terms of the 45 days, it's a dream come true.
Awesome.
Okay? I'll even take it another step further. We get calls on a regular basis. Hey, I'm on day 40. Hey, I'm on day 44. My primary deal just fell through. Okay? I just heard about this thing called a DST. What should I do?
What is it? How does it work? What do I do?
And by the way, I have $2 million in this account over here, and I got to figure this out.
Let's play on that a little bit more and expound on what happens in the situation where you're talking to a client, you're working with them through the ID period, and the DST offering fills up without causing panic and all the frustrations that come with that. What does that look like?
Hey, I just heard this the other night where it happened to an advisor who doesn't really do this for a living, right? And let's get right into that. There's a whole bunch of people that think that they do this for a living, but really they do something else, right? So it's more likely to happen in that scenario where they don't have a long-standing relationship with the sponsor. Okay. In my case, if we're going to put something on the ID form, we're also going to put in a reservation for equity.
Is that right?
Right.
Okay.
So you have a primary property that you're trying to invest in, right? But it's not going to close for another 60 days. Okay. The remainder is going to go into a DST. Okay. We don't know what that number is until we close over here, right? We satisfy our 45-day requirement by putting this DST on the ID form. Okay. We have 60 days to get this closing done before we know what this number is going to be. Okay. So what happens? Once we put it on the ID form, we call the sponsor. We say, hey, we need a reservation for about this much. They put it in, and because we have a long-standing relationship, they're going to hold equity for us. Okay. If that offering is filling up, like all the equity is going to other investors, they're going to give us a call and say, hey, where are we at with this reservation, right? And I'll call the investor and say, hey, this thing's filling up, and we need to come up with a round number and get you invested in this thing.
Okay. Two-part question here. How do you coordinate with QIs? And have you had any issues with the ID and the identifications or closing time limits?
You know, we work with QIs literally every day, right? Whether it be the ID forms or whether it's, you know, going back and forth with the subscription documents, whether or not it's, you know, determining how much is left in an exchange, right? We have a great relationship across the industry, and hey, I think they understand that it really helps to work with somebody that does this every day, right? And so, yeah, I love working with QIs, right? There's great back and forth, and it's just, you know, it also works well for the investor that we know most of the QIs in the industry.
Great. Thanks for sharing that, Paul. Let's move over to the investor side, and we're talking about suitability, what suits them, what fits their needs. What type of investor is a DST best suited for? When you look at, when you're unpacking the information that they're giving you?
First off, to invest in a DST, you need to be what's called an accredited investor. Okay, what does that mean? It means that you have a net worth outside of your primary residence of $1 million or more. Okay. Oftentimes when people are coming to us through a 1031 exchange, they have a large dollar amount coming out of that to begin with, right? There's a few other ways to qualify as an accredited investor. As an individual, you can make $200,000 or more. As a married couple, $300,000 or more. Or you could have a license like I have. right? A Series 7 or a 65 or a 66 or a 63, right? So those are the ways to qualify as that. But who do we see as clients? In general, it's people that have owned, their real estate for a long period of time.
Got it.
Okay. Highly appreciated real estate, usually at a very low cost basis, usually with no financing at all. Okay. That's a very typical client. Okay. We see lots of people that are doing their estate planning. Okay. If you're in your 80s and you've owned this piece of real estate for 40 or 50 years, you're just getting your house in order. We have those calls all the time, right? So whether we're working with estate attorneys, CPAs, people that are getting their estate planning in order, it's very typical for us to be talking to them.
Excellent.
Okay. Their kids might not want to manage this asset that they've seen their parents manage forever, right? So giving this asset to their kids doesn't make any sense at all. So let's sell the asset right now. Let's do an exchange. Let's roll it into a passive real estate investment. And then when I pass, there's a step up in basis, meaning that the taxation is wiped clean.
Right.
Right. And now the heirs get that stepped up basis. If somebody passes, what happens? Okay. The distributions go to the, heirs, right? And however the trust or however you have it set up to go to the heirs.
And then those heirs could finish the DST in the name of their parents or whatever that was set up as.
That's right.
Okay.
And so then when the asset sells, they don't have to exchange anymore. They can cash out with that stepped up basis.
Perfect. Let's have some fun now, Paul.
Okay.
Explain to our audience today the difference between, now we could have an all-day conversation about this,
could.
but for timing standpoint, let's keep it simple.
Yes.
Tell us the difference between a DST and a 721.
First off, we have a white paper. So if anybody's looking for a deeper dive into this, and like Rob said, we could talk all day about this. It happens to be a very hot topic. Right now, the industry is about 50% into 721 uprates.
That high.
50% or more, potentially. Okay. And we can get into the dynamics and why that's the case. But let's first off define what the difference is. Okay. I define a traditional DST as a standalone commercial real estate that you can use for replacement property. Okay. What is a 721? Really, it's a two-step process to get into a REIT. Okay. So a 721 UPREIT is what it's called. Okay. Let's call it that. Okay. So how does that look? An investor goes into a traditional DST, but they do that knowing that the buyer of that DST is going to be the REIT. Okay. You know that going in. Okay. So there's a lot of variables to consider here, and there's reasons why people should do this. I certainly do, my share of 721 UPREITs, but in general, it's for a very specific reason. Okay. So, why do people do 721 UPREITs? Typically, it's because they want liquidity, right? They want a liquidity option. How do I have access to my cash in as fastest time frame as possible? Okay. That's what we see.
Okay.
Okay. So if you want access to your cash in the very fastest way possible, that is one way to do it.
We could follow up with another DST 721 webinar later down the road.
Yeah, but hold on. Let's get into one more thing as to why it's more liquid.
Okay.
Okay. Because what you're doing is you're trading a real estate asset for operating units in the REIT.
Correct.
Okay. So you still get advantages of owning real estate, right? Because you're in the REIT. Okay. But now when you want to sell operating units, you absolutely can. Okay. There's all kinds of things to get into there as well. Okay. But that's the basic premise.
Got it. All right. Well, thanks for sharing that. I know we can go a lot deeper into this.
Deeper. Yep. And one more thing that we should bring up, you lose your ability to ever do another 1031 exchange.
And that's an interesting point. Let's talk about that in a little more detail. So do you make your clients aware of that when we do a warm handoff to you, introducing you to a client that we know they're not going to buy real estate, they're interested in alternative investments, but they've been kind of looking at, say, a JLL, Blue Owl, Hines. Do you make them aware of that situation?
I do.
Okay.
Right? I think 721s absolutely have a place for the right people. Okay. Is it the overall solution? I don't think so.
Okay.
But I'm just a real estate guy, right? I like to preserve the ability for people to continue to do exchanges, right? So that's just my stance on it. We'll see how things shake out into the future.
Okay. Well, I appreciate your candid opinion on that, but just for the sake of our audience following us on the DST 721 UPREIT side, just want to keep it simple and kind of separate the two. Let's talk about diversity diversifying across multiple DSTs. When you're talking to a client, how do you manage that with so many options?
Yeah, so typically a client will sell one asset, right? Whatever it is.
Say it's an industrial building.
They sell an industrial building for $5 million. $10 million, whatever that number is, right? $20 million, right? In our world, we're going to advise diversification, right? We are looking to put together the best risk-adjusted return, right? And because of all the assets being available as is right now, and we can qualify them quickly, we typically like to put together a portfolio. So how that works with us is that we're going to use a spreadsheet called a portfolio builder, okay? And there we can put together scenarios of the best way to put together a portfolio, okay? Let's say it's $4 million and we want to split it 4 different ways with 4 different $1 million investments. Portion of that might go into a 721 UPREIT for some liquidity reasons. We have asset classes that we like right now, right? So things like industrial or multifamily or maybe land or something along those lines. And we are going to try to maximize your monthly distribution. We're going to try to provide the best possible tax benefits that we can. We're going to try to diversify by location, right? So, these assets are somewhere in the United States, but maybe Florida or Texas or one of the no state tax states. We see those being very popular. And then at the end of the day, we're choosing sponsors that we like to work with and that are going to protect investor capital or potentially invest right alongside you, right? And take a portion of the equity themselves. So that's what we try to do, is diversify and provide the best risk-adjusted return possible.
Great. Thanks for sharing that with us, Paul. Moving on to your crystal ball. What do you see happening with the DST industry in the next, say, 1 to 3 years?
I don't have the exact statistics, but this industry is growing significantly. The transfer of wealth just from an estate planning process is, I've heard numbers in the trillions, right? So what does that look like? Well, it looks like this is a growing industry. One thing people don't want to do, first and foremost, or the one thing that they do want to do first and foremost, is defer their taxation. Right?
I think that's the number one motive in the 1031 world.
Always. Okay. Then they want capital preservation. They want, to make sure that their money is going to stay safe. Right. And then they want distribution. Right. They want some monthly cash flow, and they want to get their estate planning in order. So they want to be able to pass these assets to their heirs. Right. So what do I think is going to happen in the next 1 to 3 years? Well, we're on track to do $10 billion in equity this year, equity raise, right? I don't know, beyond that, but it seems like we're only going to be growing from there.
Good. So positive outlook then.
For sure.
Perfect. I want to be respectful of time here. We're coming up to the quarter to the hour. So let's just pick one of these because I think we've answered some of these questions already. What percentage of prior DSTs have you seen go full cycle? And what were the outcomes of those, Paul?
Yeah, so we see it across the board today, right? Sponsors are buying and selling all the time, okay? Again, it depends on when you bought, right? And when you're selling an asset class and everything else, right? So we've seen everything across the board, right? One of the sponsors, has a very long track record, and they, have had a multiple of 1.6. So if you're putting in 100,000, over 5 to 7 years or whatever your hold time is, their long track record gets you to there, right? But I've seen, things sell for very close to par, right? I've seen things in the 721 up rate world where they're selling at a discount, right? And so again, if we're going to get into that 721 world, there's a lot to talk about there.
Okay. I like it. Moving on to investment strategy and asset selection. Again, we've answered a lot of these questions already, but when it comes to asset classes, what are you primarily focusing on now and what are you bullish on?
Yeah, so if you look at the cycles of different asset classes, industrial has outperformed for a long period of time. We're fans of industrial. You see that in the triple net space, so it's a simple format. It's easy for investors to understand. It's also an asset class that offers zero leveraged deals, right? We like multifamily. We think multifamily is selling at a discount right now. The sponsor groups are able to go out. There was an oversupply of multifamily throughout COVID, right?
Right.
Cap rates compressed. There's discounts in multifamily. So we're a big fan of multifamily today. We like the diversification of risk, right? If I have an asset with 400 tenants that need to renew on a monthly basis, right? We can raise rents with inflation. And, hey, these guys everybody needs a place to live. If we get into a high inflationary period like we were in several years ago, hard assets, multifamily.
And your thoughts on medical?
Hey, if we see the right, medical deal, we like that as well.
Okay.
Right.
All three are strong verticals.
It's tricky because oftentimes it's a smaller raise, right? And if you come out with a smaller raise in medical, it's gone, right? It's gone before the market even knows it's there.
Right. Well, thanks for sharing that. We got 10 minutes left, so let's condense this down to what we can and then open the floor to any questions our audience may have, Paul. When we look at returns, cash flows, you want to talk about projected cash-on-cash returns versus IRR, and how stable is the income stream, and what are the biggest risks to distributions?
Yeah, so the cash-on-cash is your monthly distribution, right? You throw in 100,000, and if it pays 5%, you're going to have $5,000 coming in, right? If we're talking about IRR, right? Now you're a percentage owner of this building. When it sells, you're going to get your percentage of that gain, right? That the combination of the distribution and your percentage of the gain is going to get you to your IRR, right? Hey, how stable is this? Right? Stability of cash flow comes from the operation of the asset. That's where cash flow comes from. If you have a great operator with a great asset in a great market, you're going to have very stable cash flow. If you are going into a triple net property with a super solid tenant, you're going to have very stable cash flow.
And with any investment, there's of course risk involved.
For sure. Hey, if I'm managing a duplex myself personally and I have a tenant leave, I have cost to it, right? I got to go redo a unit, right? It's not any different in this. It's just that you're not the one going to redo the unit.
That's right.
Right?
So fees and compensation, you mentioned that earlier when we first started off, so you kind of leapfrogged us here, but what fees are embedded at the sponsor level, advisor level for your clients?
Yeah, so I get paid very similar to a buyer's agent in a real estate transaction. Clients aren't writing checks to me. Okay. That said, there is a front end load that the sponsor builds in to pay everybody up front.
Right.
Okay. And so that comes out right away. Okay. Who does that get paid to? That gets paid to my broker dealer. We have splits, and then it goes down from there.
Got it.
Right. That's at the advisor level. On the sponsor level, it really depends on the asset. Okay. If I'm managing a 400 unit multifamily, there's an ongoing management fee, right? It's labor intense. Okay. Was there an acquisition fee? There might be an acquisition fee. Is there a disposition fee? There might be a disposition fee, right? The sponsor gets paid for buying and selling and managing the asset.
And much like the exchange, for a cost of the sale, they don't write us a check if it's a credit card number. It doesn't work like that.
That's right. It comes out of the proceeds.
Right.
Right. And in our case, it's embedded in, the overall offering.
Got it.
From the sponsor.
Well, we've unpacked a lot of information today, Paul. Let's open up the floor for any questions for our guests today. And again, if we can't get to you on questions, you have Paul's information here, his phone number, his email address. Please feel free to reach out to Paul offline, and he can answer any questions, no matter how detailed they are, and likewise with me on a 1031 exchange standpoint. But to our audience today, does anyone have any questions regarding what we covered and like to answer a couple of questions for you while we have you?
No questions?
I don't see any. Okay. That just gives us an itinerary of who's here. Yeah. If anyone has any questions, now's the time to jump in, and Paul or myself would love the opportunity to answer those questions for you. If not, we appreciate your time. We know you all have busy schedules, but we appreciate you joining us today and joining our webinar.
Thanks, everybody.
Thank you. Appreciate your time, everyone.